What if I told you there is a company that convinced millions of Americans to completely change how they pay for things, and in doing so, built one of the fastest-growing financial networks in the country? No credit card swipe, no hidden fees, no nasty surprises at the end of the month, just simple, transparent installment payments. That company is Affirm Holdings, ticker AFRM. And whether you're a consumer, an investor, or just someone trying to understand where the future of money is headed, this story is one you genuinely need to hear. Let's go back to the beginning. Affirm was founded in 2012 by Max Levchin, one of the co-founders of PayPal. And right away, you can feel the DNA of someone who spent years thinking about digital money and trust. Levchin looked at the credit card industry and saw something broken. He saw a system built on confusion, on minimum payments that trap people, on interest that compounds before you even realize it, on fees buried in fine print. His vision was radical in its simplicity. What if you told people up front exactly what they would owe and then never changed that number? No late fees, no compounding surprises, no gotcha moments, just a clear deal. And that philosophy became the foundation of the company. Affirm is a buy now, pay later platform, often shortened to BNPL, but calling it just BNPL undersells what it actually does. The company positions itself as a payment network, sitting between merchants and consumers and facilitating installment loans at the point of purchase. When you go to buy a Peloton bike or book a vacation through Expedia or shop on Amazon, you might see Affirm pop up as a payment option. Instead of paying the full amount today, Affirm lets you split it into manageable chunks over weeks or months. They show you the total interest cost right there on the screen before you agree to anything. That transparency is the brand. It's what separates them, at least in their own telling, from the predatory edges of traditional consumer credit. Now let's talk about the business model, because this is where things get interesting. Affirm makes money a few different ways. Merchants pay them a fee for offering Affirm at checkout, because having a flexible payment option at the point of sale increases conversion rates and average order values. Consumers on interest-bearing loans pay interest to Affirm, which then packages those loans and sells them to investors in the capital markets, keeping a spread in the process. They also earn revenue from servicing those loans. It's a layered model, and the key metric investors watch closely is gross merchandise volume, or GMV, the total dollar value of transactions processed through the Affirm platform. That number tells you how much commerce is flowing through their network, and it's been growing fast. In its fiscal first quarter of 2025, Affirm reported GMV of $7.6 billion, a 35% increase from the prior year, and revenue of $698 million, growing 41% year over year. Think about that for a second. Revenue growing faster than volume, which signals improving unit economics. The company isn't just getting bigger, it's getting more efficient at monetizing each dollar of transactions it facilitates. Looking at the broader trajectory, Affirm's annual revenue has grown at a pace that most financial companies would envy, compounding rapidly off a base that was already substantial. This is a company with real momentum. Let's not get swept up too quickly. Affirm has had a complicated relationship with profitability. The company went public in January 2021, at a time when growth had costs. Startups were being valued at eye-watering multiples, and its stock shot up dramatically. Then came 2022. Interest rates rose fast. The growth stock bubble deflated. Affirm's share price collapsed by over 80% from its highs. Critics pointed to ongoing losses, high funding costs, and a rising rate environment, and the question of whether BNPL was just credit card debt wearing a trendier jacket. The company had some real soul-searching to do. What happened next says a lot about Max Levchin and his team. Rather than chase growth recklessly, they focused on unit economics and discipline. They leaned into their underwriting technology. Affirm built its own proprietary credit scoring system rather than relying on traditional FICO scores. Using real-time transaction data and behavioral signals to assess creditworthiness, this allowed them to price risk more accurately and, importantly, to say no more selectively. Their delinquency rates became a point of differentiation. The quality of their underwriting, particularly for higher-priced, interest-bearing purchases, became something that set them apart from a growing list of competitors facing commoditization risk.